Your bank is making approximately 68 times more money from your savings than it is paying you for them. That is not a metaphor. That is the actual math of how a standard savings account works. And the reason almost nobody knows this is that banks have been very successful at framing their custody of your money as a service they provide to you, rather than a product they sell using your deposits as the raw material. There is a number above which keeping money in a standard bank account is one of the most expensive financial decisions a person earning a decent income can make. And this video tells you exactly what that number is, why it exists, and what to do with everything above it. And before we get into the number, there is one thing worth understanding about the mechanism, because understanding the mechanism changes how this feels from an oversight into a decision. How the bank's business model works. Most people who have a savings account have never thought about what the bank does with the money while it is in there. And that gap in awareness is not accidental. It is the product of every customer service interaction, every app design decision, and every piece of marketing that frames your bank as your financial partner. And the partnership framing conceals a transaction that runs in exactly one direction. When you deposit money into a standard savings account, your bank pays you the deposit rate. At the national average major bank right now, that is approximately 0.41%. Your bank then takes that money and lends it to mortgage borrowers and car loan customers and credit card holders at rates between 6 and 24%. The spread between what they pay you and what they charge borrowers is the bank's primary revenue source. On $10,000 of your savings, the bank earns approximately $600 to $700 a year and pays you approximately $41. That is the 68 times ratio, and it has been the core of retail banking's business model for the entire history of the industry. Naming this is not an accusation, it is a description, and the description is what makes the number important. The number. Most personal finance content treats the question of how much to keep in a bank as a personal preference. Some people say 3 months, some say 6 months, and the discussion rarely goes further. But there is a principled answer to this question, and it is not arbitrary. It comes from understanding what the money in a bank account is for versus what money outside a bank account can do. The amount that belongs in a bank is your emergency fund, defined as 3 to 6 months of your actual monthly expenses, not your income, your expenses. And this number exists for a specific reason. An emergency fund needs to be instantly accessible without penalty, without price fluctuation, and without any process that introduces delay between the crisis and the cash. A bank account does all 3 of those things correctly, and for that specific purpose, it earns its place. Everything above that number is not an emergency fund anymore. It is a savings surplus. And a savings surplus held in a standard bank account is not safety. It is the 68 times transfer problem running every single day on the balance above your 3 to 6 months. The practical test is simple. Take your average monthly spending and multiply by 5. That is the midpoint of the range, and a reasonable starting target for most people earning between $55,000 and $130,000 a year. Everything above that number is costing you in a way that never appears on a statement. What the loss actually looks like. The problem with an invisible loss is that it never triggers the alarm that a visible loss would. If your savings account balance dropped by $1,400 in December, you would notice. You would investigate, you might call the bank. But when that same $1,400 simply never arrives because the rate is wrong, the loss is completely silent, and most people carry it for years without ever calculating it. Here is the math that makes it visible. If you have $30,000 in a standard bank account earning 0.41%, you earn approximately $123 this year. If that same $30,000 were split between a high-yield savings account earning 4.5% for the emergency fund portion and short-term treasury bills earning 5.2% for the surplus, the total return approaches $1,500. The difference between those two outcomes is not a different level of risk. It is not a different level of complexity. It is approximately 40 minutes of one-time account setup. The $1,377 gap is what silence costs on a $30,000 balance, and that number scales directly with the balance above your emergency fund threshold. And if the 68 times ratio and the math on your actual balance just made something click that has been sitting quietly in the background, The like button is right there. It means this video keeps getting made and I get to keep doing this math on behalf of people who were never shown it, where everything above the number belongs. The most common reason people do not move money above their emergency fund threshold is that the alternatives feel complicated, risky, or like they require expertise they do not have. And that feeling is exactly what makes the bank's position so durable. Complexity is the moat that keeps the 68 times transfer running. The alternatives are not complicated. They exist on a simple spectrum from lowest risk to moderate risk, and every point on that spectrum outperforms a standard bank account at current rates. The first alternative is a high-yield savings account. These are FDIC insured to the same $250,000 limit as a standard bank account. They are offered by institutions like Marcus by Goldman Sachs, Ally Bank, and Marcus. They currently pay between 4.3 and 4.8%. They are online only, which is the trade-off for the higher rate, and they function identically to a standard savings account in every way that matters. Same insurance, same accessibility, same withdrawal process. The only difference is the rate, and the rate difference at current levels is not small. The second alternative for money you will not need for 3 to 12 months is short-term treasury bills. These are direct obligations of the U.S. government. They are currently paying between 4.9 and 5.3% depending on maturity. They are purchasable directly at treasurydirect.gov with no fees, no intermediary, and no minimum above $100. They are exempt from state and local taxes, which adds another 0.3 to 0.8% effective return, depending on your state. And they're the closest thing to a risk-free investment available to an individual investor, because the counterparty is the federal government. The third alternative for the surplus that has a longer time horizon is a low-cost index fund inside a taxable brokerage account. This is where the risk level steps up meaningfully. The value fluctuates, and it should only hold money you will not need for at least 3 to 5 years. But for the portion of your surplus that qualifies, the historical return premium over a savings account is large enough that excluding it from this conversation would be intellectually dishonest. The allocation model that makes sense for most people in this audience is this: 3 to 5 months of expenses in a high-yield savings account. Any surplus above that with a horizon under 12 months in treasury bills. Any surplus above that with a horizon over 5 years in a low-cost index fund. And the specific amounts depend on your situation, but the principle does not. The circular truth: your bank is making 68 times more from your money than it is paying you for it. Not because you made a bad decision, but because nobody sat down with you and explained what the number is above which that transfer becomes genuinely costly, and what takes its place. The answer is 3 to 5 months of expenses in the account that is optimized for accessibility, and everything above that number in accounts that are optimized for return instead of optimized for the bank's earnings report. The emergency fund belongs in a bank. Everything else belongs somewhere that is working as hard for you as it is for whoever is currently holding it. I make these videos because I find it genuinely unreasonable that the mechanism behind the 68 times ratio is considered too complicated for a standard conversation about where to keep your savings. Subscribe so I can keep being unreasonable about that on your behalf. The video on your screen right now might be more helpful for you, so click and watch.